Here we are with the stock market at new all-time highs, and we're talking about cheap stocks. Well, I like to say there's always a stock to buy. And when we're talking about cheap stocks, we're not talking about stock price. We're talking about valuation. That's right, a $50 stock could in fact be more expensive than a $500 stock from a valuation perspective. Far too often, investors associate stock price with valuation, but they're missing the point. This day and age, most investors have access to fractional shares. As such, $100 invested in a $50 stock will buy you 2 whole shares. But $100 invested in a $500 stock only buys you a fifth of a share. However, if both of these companies go up 10%, you're going to make $10 gains in both investments. Focus less on stock price and more on valuation. And as such, in today's video, we're going to be focusing on 4 undervalued stocks across different sectors. So make sure you stay tuned throughout the entirety of the video so you don't miss one of these. And before we jump in, do me a huge favor. Show your appreciation for the videos by just simply clicking that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. Right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into our video, taking a look at 4 undervalued stocks, beginning with stock number 1, which is going to be Novo Nordisk, stock ticker NVO. And before all of the AI hoopla, really the major focus for investors for quite some time was the new GLP-1 weight loss drugs. They really started off by focusing on diabetes, but the 2 headliners were Eli Lilly and Novo. Eli Lilly, better performance, has really taken the lead there. But when it comes to Novo, they're 2 drugs, which you could look at the same, are Ozempic as well as Wegovy. However, in terms of next growth steps, they're looking to expand the use of these 2 primary drugs, along with many others they have. The company currently has a market cap of $232 billion. Over the past 12 months, get this, shares are down 50%, and year to date, down 20%. Novo is obviously a healthcare company, and when you look out over the past 12 months, one of the worst performing sectors in the S&P 500 has been healthcare. And when you look at a year-to-date perspective as of this video, the only sector that's currently in the red is healthcare. So when looking for cheap, undervalued stocks, looking at the underperforming sectors is a great place to start. But when it comes to Novo and performance, revenues, operating profit, and operating margins have increased greatly the past few years, with revenue sitting at $47.5 billion, operating profits at nearly $23 billion, and operating margins at 48.4%, the highest in the history of the company. Growth and efficiency are 2 things we love seeing moving higher at the same time, and they can also help pay a reliable, growing dividend. Speaking of that dividend, the company currently pays an annual dividend of $1.66 per share, which equates to a dividend yield of 2.4%, and they have a 5-year dividend growth rate of 22% and 5 consecutive years of dividend growth. In terms of valuation, the company has traded at an average PE multiple of 29.3 times over the past 5 years and 24.4 times over the past 10 years. But today, you can pick up shares for just 16.6 times, well below the company's historical averages. And this price is cheaper than before they even had these GLP-1 drugs that are growing in popularity. Analysts rate the stock a moderate buy with an average 12-month price target of nearly $80 per share, implying 15% upside from current levels. And that brings us to stock number 2, which is going to be Marvell Technology, stock ticker MRVL. And when we're talking about the technology sector, particularly semiconductors, and putting the word cheap stocks next to it, that's hard to come by. But Marvell and a few others, they are actually cheap. So far in 2025, the popular semiconductor ETF, SMH, has outperformed the S&P 500 to the tune of 17 0.4% versus 7.3% for the S&P 500, a dominating performance through the first half of the year. But again, when sifting through semiconductor stocks, Marvell and a few others still look quite cheap. And the company currently has a market cap of $63 billion. Over the past 12 months, shares are down 1%, and year to date, down 34%. Marvell is a huge player when it comes to custom chips. And with the growth in AI still in its infancy, in my opinion, really the trajectory is high here. However, the stock has come under pressure of late due to the likes of some of the Mag 7 companies producing their own custom chips. Quite frankly, of late, the report from Microsoft, which could lead to less reliance on Marvell. Other companies producing chips, that's been a threat for NVIDIA, that's been a threat for AMD. These chip companies go through these cycles. It doesn't mean it's not a threat, it just appears that it might be overblown though. In terms of performance, revenues and EBITDA are at or near all-time highs. Revenues sit at $6.5 billion, which is an all-time high. EBITDA at $1.7 billion, just $0.05 billion from an all-time high, which they will surpass this year. In terms of valuation, the company has traded at an average forward PE of 31.7 times over the past 5 years and 26.8 times over the past decade. And again, this is a company that's been ramping up its growth. Today, though, those shares trade at a forward PE of just 24.4 times, well below the company's historical averages. EPS growth this year and next year averages out to around 50% per year, giving the stock a PEG ratio of just 0.5, showing just how incredibly cheap you are paying for the growth you're getting. Analysts rate the stock a strong buy with an average 12-month price target of $91 per share, implying 25% upside from current levels. And that brings us to stock number 3, which is going to be United Health Group, stock ticker UNH. Now we're reverting back to the healthcare, but it's just a very different healthcare company. When we looked at Novo, they were a true pharmaceutical type healthcare. This is a insurance company, and this is a company and a stock that has been under siege of late. It started really at the beginning of the year or end of last year with concerns around higher medical costs. Then we saw the murder of one of their segment CEOs. Then the head CEO stepped away. Then we got fraud reports and an investigation that's been ongoing, and it's just been one thing after the other, sending shares tumbling. It was a lot to take in over a 3 to 6 month period, but currently the company has a market cap of $276 billion. Over the past 12 months, shares are down 41%, and year to date, much of the same, down 40%. So that shows you all of this has happened in 2025. Investing in UNH doesn't come without risk, don't get me wrong there. But the valuation the stock's trading at right now incorporates a lot of those risks. You're not paying the heavy premium that investors typically pay for a company like UNH. So you're getting a huge discount right now. I mean, this is a stock that was trading at $600 per share, and today we're talking about a stock trading at just $300 per share. And when we look at performance, UNH has been as steady as they come. But the concern right now is about lowering margins due to higher medical costs. But the thing with UNH is they have the ability to adjust their premiums at the end of the year. So if anything, this would just be a short-term hit to the financials. In terms of valuation, the company has traded at an average PE multiple of 20.2 times over the past 5 years and 18.8 times over the past decade. Today, shares trade at just 13.9 times, well below the company's historical average. And when it comes to analysts, they rate the stock a moderate buy with an average 12-month price target of $376 per share, implying 25% upside from current levels. And that brings us to our fourth stock today, which is going to be PepsiCo, stock ticker PEP. PepsiCo is one of the largest beverage companies in the world today. But when I've polled investors on either X or YouTube in the past and compared them to their close competitor in Coca-Cola, a lot of people prefer Pepsi. And why do they prefer Pepsi for a stock? It's because of their snack division. They believe that it diversified the company more than Coca-Cola. What is the thing dragging the company down right now? Largely due to their snack division. The company currently has a market cap of $185 billion. Over the past 12 months, shares are down 17%. Year to date, they are down 8%. And take a look at this chart here showing the performance of both Coca-Cola and PepsiCo just in 2025 alone, showing the two stocks going in opposite directions. KO shares up 14%, PepsiCo shares down 8%. The challenges when it comes to PepsiCo right now, not saying that Coca-Cola doesn't have them, but it's tariffs, it's GLP-1 headlines, it's also the Department of Health, as well as concerns around the macro environment. This is a global company. Again, though, these are all fair concerns, but when you look at the valuation compared to historical averages, you have to ask yourself, well, is a lot of this priced into the stock already? And when you look at the stock price, we are trading at the same levels we traded at during a global pandemic, and we're nowhere near that environment right now. In terms of performance, revenues and EBITDA are sitting right around record levels. Revenues at $91.5 billion, just shy of last year's record, and EBITDA is sitting at $17.3 billion, which is in line with last year's record highs. When investing, you do want to be mindful of an article you read or what others are saying, and you want to also, though, look at the results. This is the stock trading as if the results and the performance have fallen off a ledge, but I just showed you the results. In terms of valuation, the company has traded at an average PE multiple of 22 times over the past decade, EV to EBITDA at 15.7 times over the past decade. Today, you can grab shares at a forward PE multiple of just 17 times and an EV to EBITDA of just 12.5 times, the lowest in the past decade. Again, this isn't a stock that's going to blow your socks off in terms of growth. And if you're investing in this company for huge amounts of growth, then you're not investing in it for the right reason. But if you're looking for a stable, high-quality company, dividend paying, or a dividend king, this could be a good addition to your portfolio. And speaking of that dividend, the company pays a dividend that yields 4.2%, and they are also a dividend king, having increased their dividend for 52 consecutive years and counting. When it comes to analysts, they rate the stock a moderate buy with an average 12-month price target of $148 per share, implying 10% upside from current levels to go along with that 4.2% dividend yield. So there we just looked at 4 very different companies that look drastically undervalued. We had a few healthcare companies with an insurance company and more of a pharmaceutical. We actually found a technology company as well as a consumer staple company. Down in the comment section, give me a few other ideas and let me know which of these 4 stocks you would likely invest in at these current levels. And if you haven't done so, please show your appreciation for these videos by simply clicking that like button down below. It really helps the growth of the channel and spread this video out to others, and I really appreciate it. So thanks so much for watching and for the support, and we'll see you in the next one. Take care.